May 30th, 2024. Today, I thought it was really interesting that we kept the gap open with yesterday's low. Like I mentioned yesterday, usually when you get a gap down, the first thing the market is going to, traders are going to pay attention to is the prior day's low and see if the bulls are able to fill the gap. And if they are, then it's less likely that you're going to have some sort of bear day. However, today, the bulls were not able to fill the gap. And so it increased the risk of some sort of sell off later in the day. I didn't think this would happen, but just something to note is the open gap did increase the risk of something like that happening. So gap down, bar one, a bear bar, but big tail on the top and big tail on the bottom. So really not that great of a sell. Any given bar has about a 20% chance of being the higher low of the day. And I would say, or sorry, any given bar number one has about a 20% chance of being the higher low of the day. And I would say that bar one is still about 20%. Probably buyers not too far below, probably sellers not too far above. Bar two, a reversal bar for the bulls, or a reversal bar up essentially because it closed above its midpoint. Probably sellers above. Bulls see a high one, but it's a bear trend, so no one's really going to be willing to buy above bar two. Most likely sellers above who will be willing to scale in higher. But this is not the follow through that the bears wanted. Went from the gap down. So what are bears going to do? They're going to look for either a good second reversal to sell or look to buy or look to just sell a lot higher, or they need consecutive bear bars closing near their lows in order to look to sell down here. Three, a bull bar. Some would argue 1-3 double top, but not really all that good. Probably buyers below three, probably sellers not too far above three. So again, this just looks like classic trading range open to me. Buyers below three during four. Am I buying, below three? I personally did not because, well, I don't trade on limit orders, but it's still probably always in short from the gap is something to keep in mind. So that's one of the reasons why you shouldn't buy four or five, six, or seven is because if you're buying there, you're buying against the always in position and it's not really all that strong. So something to keep in mind is that, from yesterday's sell off and the gap down, we're probably always in short. So you can see we got buyers below three during four, but probably most of those traders just scalping. Could be a second leg down from one and two. Five, an outside up bar, but doesn't close above four. And to me, it looks like you're buying high in a trading range. Follow through for the bulls. It's consecutive bull bars, but it's not really all that good. Six has a huge tail that overlaps with five, and if you're going to be buying, when you're always in short, you want to see something that's pretty strong. And this really is not that strong. To me, this just looks like a trading range open. More follow through on bar seven, but again, a big tail on the bottom. So five, six, seven, all not ideal bars because huge tails, lots of overlap. So I don't really want to buy anywhere up here because there's so much overlap. Eight, a bear bar closing near its low. I think eight was a credible sell. You have a double top with one. The neckline is the low of two, which is the lowest price between those 2 points. But I thought the low of bar five was going to be an important price to see how we acted below as well, since it was a good bull bar. And when you have an open gap early in the day, like you do here with yesterday's high, so you have an open gap and you have a bear bar closing near its low, that's a second entry sell. It's probably, going to be a credible sell. So I think eight, a reasonable double top. The problem with eight is that five, six, and seven are pretty strong, or at least strong enough to get a second leg. And unless this is a bear trend day, we're probably going to get back to the seven close. So while this looks like it might be a leg in a trading range, the open gap makes me think it's possible that this is going to be some sort of bear trend day. And then bar nine, big follow through. But the problem with nine is it's too big. A lot of times the traders who sell below a bar like eight, they're hoping for good follow through, but they're not really all that convinced they'll get it. Their premise is that this is some sort of bear trend day and we're going to keep the open gap with here. And instead you get a huge follow through bar on nine. If I took the sell on eight and I got a ton of follow through on nine, I'm probably going to look to scalp out and just take my profit. And that's exactly what a lot of traders do. They use the sell off on bar nine as a chance to just make a quick 8 to 10 points and just exit the trade and look to sell again higher. Do you sell the close of nine? I probably wouldn't. You're probably going to get a second leg sideways to down from it, but it could be a pretty deep pullback. So some traders might look to sell more of a 50% correction of bar nine and or eight and nine rather than directly below it. 10, an inside bar. It's a possible low of the day, but a big tail on the top does not inspire confidence for the bulls. I still think more sideways to up rather than down. So more sideways rather than up or down. And 11 does something interesting. You can see it trades back to one tick below the low of of bar 8. So the traders who sold below bar 8, you know, they got pretty good follow through, and a lot of them scalped out, and they tried to enter back in at that same entry price. And this happens a lot, especially in trading ranges, where traders will try to re-enter at the swing price after they've seen the follow through. And that's why you can get the tail on bar 11, because traders, they see that the swing went pretty quickly and that we're probably going to get a second leg down from 8 and 9. So they know that when they're selling during bar 11, that it's probably not going to be some huge bear trend, but reasonable enough chance that we end up getting a second leg down from 8 and 9 and at least reaching the bar 9 close. Bar 12, an inside bar. It's a high one for the bulls. They're hoping that 10 was the low of the day, and this is the start of a bull trend, and we're going to trade strongly above bar 12 and rally to the 7 close, but they know it's probably not going to happen. The bears, it's a low one short, but that's a more credible argument, the low one short, but still a huge tail on the bottom of 12, so really not all that ideal. I think, again, better to wait and just see what you get. 13, a good bear bar closing near its low, and I thought 13 was a credible sell as well. The reason being, you now have an open body gap, right? So you have the open body gap here, and you have the open gap here. When you have two open gaps early in the day, a lot of times that'll lead to a trend. Let me just throw this in here. But I don't know. Here's a couple examples. Two open gaps early in the day. We got a trend. Bear trend with two open gaps. Bull trend, two open gaps. Bull trend, two open gaps. So you can see lots of good examples of a lot of times early in the day when you get two open gaps, you can get some sort of trend. So anyways, 13, a bear bar closing near its low. I think it's a credible sell below 13. You're hoping that we've seen the high of the day and that this is a bear trend day. I think that's the argument for selling below 13. The problem is, that you're probably going to go more sideways to down rather than straight down, because a lot of times the small pullback bear trend days have disappointing pullbacks throughout, but they don't last that long. They never flip the always in position. So that selling below 13, you're selling relatively low in what looks like a leg in a trading range, which is what it might be. But your premise is that this is actually not a leg in a trading range and you're selling in the early stages of a bear trend. 14, follow through for the bears, but tons of overlap with bar 13, and it overlaps to 12 low as well. So not really all that ideal. Also cannot close below the bar 9 low. But I still think the bear trend premise is valid because of the two open gaps and the really strong bear bars, bar 8 and 9. 15, disappointing follow through. It's a reversal up. Some bulls would say it's a wedge, 2, 9, and 15, but no one wants to buy above a bear bar. Probably sellers above scaling and higher. But we could get two legs sideways to up because of the credible wedge argument, 2, 9, 15. So it's okay to stay short below 15, but you just have to keep in mind that we might pull back for 3 to 5 bars before we continue down. 16, a bull bar, but a big tail on the top. It's really not all that ideal. I think if I'm short, I'm not really that worried about 16. I'd rather wait and see what happens. I think a reasonable stop at this point would be above 11 if you were still short. For the bulls, they're hoping that it's follow through for the wedge, but again, it's really not all that good for the bulls. It's okay, it's something, but it's not, the bulls are not expecting very much out of this. An outside down bar on 17, so just basically a big outside doji bar. We're going sideways. Again, to me, this looks like, I don't think anyone who buys above 15 deserves to make money. Not deserves, but they have a low probability of making money. So most likely we are going to at least trade below the 15 low. It's something you can do if you're thinking, if you're sitting in a trade and say you're short and you see bar 17 and you're nervous that the market's starting to go sideways, which is reasonable to be nervous about. But at the same time, that we're probably going to get two legs sideways up, and so you realize you're going to have to sit through another leg, and put yourself in the shoes of a bull who bought above 15. So pretend instead of being short, you had bought above 15 and you now see 16 and 17. How are you feeling? Do you feel like you're probably going to get stopped out? I think you probably do. So a lot of those traders not as eager as they could be right now because they know they will probably get stopped out. 18, a bear bar closing near its low. It's good for the bears. 16, 17, 18 is an IOI pattern. So inside, outside, inside, which more or less just means breakout mode. So 18 is a credible sell. If we're going to continue down and get a small pullback bear trend day, we should probably start to go down relatively soon. Bulls have their credible first leg up pullback, and the tail on 18 would be the second leg up. So probably going to start to go down within the next couple of bars. And we have a second open body gap you can see right here. The easier way to show body gaps is on a line chart. So if you're ever thinking that we might have an open gap or open body gap, just go look at a line chart and you'll be able to see it more clearly. 19, a good bear bar closing near its low. For the bears, I think this is really strong. It's a good entry bar for 18 and an outside down bar. So IO, I suppose, but really just, again, breakout mode patterns. The breakout below 15 is going to be important since it was a possible wedge to 915, and they're looking for a breakout below and a measured move down, maybe somewhere down here or something like that. Problem is 8 and 9 was strong enough to reset the market cycle. So while the wedge, theoretically a wedge 1, 2, 3, that 8 and 9 reset the market cycle. So you might get spike and then wedge channel, which is what we actually ended up getting. Either way, I thought 19 was a reasonable sell. You are selling relatively low, so we might go a bit more sideways first. But, if we're going to go down today in a small pullback bear trend, you have, the credible open gaps. It's okay to just sell below 19. And if you get a bull bar closing near its high, you get out. And you do get a bull bar closing near its high on 20. I thought 20 changed pretty much the entire character of the day. Bulls who buy above 20 have a possible low of the day. And you have to keep in mind, bears had the argument earlier for pretty much the whole day until bar 20 that this was a possible bear trend day. That argument is no longer valid, I don't think, after 20. And if it is valid, we're probably going to need to go sideways for a little while before we can get any sort of reversal down. So the bulls who are buying above 20, they're looking to close gaps, the gaps that the bears opened. So we're probably going to get a close above the bar 5 low, right where that body gap was, or the bar 5 open. Sorry, we're probably getting back to the bar 7 close, and that's going to be a target. And this sell climax high is going to be a target. And we additionally have a failed breakout below the 18 bar range, right? Bar 18. We broke out below it, failed and reversed up. And even yesterday's low is a target for bulls, right? Because that's an open gap as well. So it's a pretty good trader's equation buying above 20. Some traders might try and buy a 50% pullback of bar 20 since the bar is relatively big and the risk is relatively big, but I thought it was reasonable to just take the buy directly above 20. Disappointing follow through bar 21. Do you sell below 21? I wouldn't. I wouldn't even exit longs below 21, I don't think. I thought 20 changed the entire day, and it made me think that this is now a wedge, and if you're buying above 20, you're buying low in a wedge channel rather than buying some pullback in a small pullback bear trend. So 21 to me is just trying to trap bulls out. 21 for the bears, they'd argue it's a low one short and they're hoping 20 is a bull trap, but 21 looks a lot more like a trap than 20 does. So probably buyers below 21 and probably sellers above 21, not too far above. Additionally, when you get the opening swing, every day, 90% of days have a swing that's equal to at least 40% of an opening day's range. And this could be it. But 60% of the time, when you get that swing, the market tries to trap traders out with some bar in the opposite direction. Be it like 21 is a perfect example. Trying to get bulls who bought above 20 to second guess themselves and exit below 21 and then have to chase the market up, adding more fuel to the buy and driving the market up further. 22, follow through for the bulls. It's a good bull bar closing near its high. Bulls who bought above 20 probably should make a 5-point scalp since it was a pretty reasonable buy. Do you buy the close of 22? You probably can buy 22, but I think the buy was more on 20 and you're looking to make maybe 5 points. Again, you can buy and just hope that we get a new high of the day and close the gaps and get to at least the 7 close. But if you're doing that, you're risking kind of a lot. And that we're going to go, or sorry, not you're risking a lot. I meant to say, that we're probably going to end up going sideways at some point and it's going to be hard to hold. 23. You can see we never trigger above 22. We tried to pull back to the 21 high. Some bears sold above 21, not very smart, but it was not unreasonable. It's not usually unreasonable to sell above a bear bar in a trading range and expect it to get back to that price later in the day. You can see, since for the most part it was a trading range, any of the traders who sold at any price we tried to close those gaps later in the day. And even the bar 21 high and the 23 low, we got back to that price later in the day. So a lot of traders using wide stops and scaling in are making money. 23 is a high one for the bulls in what they're arguing is a bull trend. It could be, it's a climactic bar on 20 and a climactic bar on 22. This could be two legs sideways to up. Or sorry, this could be two legs up for the bulls, so it could be some sort of high too. But I think that for me, two bull bars closing near their highs, even if we pull back, we're probably going to go higher overall because of how strong these bull bars 20 and 22 are. 23, a disappointing bar, or sorry, 24 triggers the high one above 23. Am I buying above 23 or 24? I probably wouldn't. It looks like we're starting to get more into the profit taking area. You can see we had the spike and now we have the wedge channel. So the bulls who bought above here might be targeting the top of the wedge channel as their profit target. 25 is good follow through for the bulls, but possible parabolic wedge 20, 22, 25. However, we're probably going to this close, and I still think we're probably going to close the gap with yesterday's low since it's a trading range day. And if you're getting a trading range, we're probably going to close gaps. But it is a parabolic wedge. And what does the parabolic wedge mean? Well, the reversal down from a parabolic wedge is probably a minor reversal. So we're probably going to get two legs sideways to down, not some sort of giant bear trend, especially considering how strong, 20 closing on its high, 22 closing on its high, 25 closing on its high. So with how strong these bull bars are and how tight the channel up is, the reversal down is probably not going to be anything major. And you can see, when you got the wedge, when you get the parabolic wedge, again, oftentimes, you end up getting a breakout above it. And this is one of those times where we got the breakout above, and you can see we got a leg one, leg two measured move. Leg one, and then leg two was the channel. So you had the parabolic wedge and then leg two channel, and that was basically where the high was. 26, an inside bar, a bear bar, but a big tail on the bottom. So not really as good as it could be for the bears. A lot of traders might exit below 26, and you can see the big tail on 27 reaching up towards the 25 close. Well, a lot of bulls prefer to buy above a bull bar closing near its high. But if you didn't take the buy on 20, you didn't really have a chance to get in because you couldn't buy above 22 because it didn't trigger on 23. Now you're buying above a bear bar. And then you try to buy above 25, but you can't buy above 25 because it never triggers. So traders know that other traders will exit below bar 26 if we trade below it. So for the first 3 minutes of bar 27, we were rallying, trying to get back to at least the 25 close. Some traders were hoping that we would get a breakout directly above the wedge. And if we got that, we might rally directly to the bar 7 close or potentially even close the gap with yesterday's low if bulls were lucky. But I thought the bar 7 close was the target for the bulls who were buying during 27, trying to get it to rally. And if you're taking that kind of buy, what you're betting on is the traders who bought the close of 25 will not feel disappointed and trapped. They'll instead think, no, I'm correct, and this is now going to go in my direction. And it's a relatively, when you get up to that price, the 25 close, sometimes the bulls will the traders who bought the close of 26, they'll just take a scalp. So really the important price whenever you're taking a trade like that is the close of bar 25. So if you're buying the close of 26, you have to recognize the close of bar 25 is a really important price because that's pretty much going to single-handedly determine how this trade is going to go. If you bought the close of 26 and you get a close above the 25 close on bar 27, it lets you know that bulls were still interested in buying at that price and we're probably going higher. And if you get what you basically got here, it tells you that bulls were not interested in buying, and instead this is probably going to turn into a trading range. So 27, a bear bar, an inside bar, it's an II pattern, but I'm not selling against the strength of those really strong three bull bars, 20, 22, and 25. Traders who do sell below 27, some follow through on 28. We're probably always in long. I would say we were always in short coming into the day and stayed always in short until, you could argue that 20 did not make the market always in long on its own, but the context of 20 made the market always in long. So on the bars, we're technically probably always in short, but contextually we're always in long above 20. And I thought 22 made the market clearly always in long. 29, disappointing follow through for the bears who were selling. Again, the channel up was really tight, and I don't expect us to go much further down before reversing up. So really not all that great to be short here. 30, a bear bar closing near its low. It's a 5-bar micro channel for the bears, which is good for them. But this is really strong, the wedge, again, so it should get a second leg sideways up. I thought we might have to trigger below 30 and try and test this low, but I thought that this was more of a channel rather than a spike. So if you think about it, the market cycle is spike, channel, trading range. And you can see, on a broader, this was the parabolic wedge with spike, this was the channel, and then we formed a trading range. And you could look at 26 as the spike and then 27 as the pullback and the start of the channel. So a lot of traders, the problem that they have, I think, in areas like this is they'll take these sells or maybe sell below, look to sell below 30. It's probably not wrong to sell below 27 or 28, but I just thought this was really strong. It's really difficult to want to short here. And you need to be really quick to get out if you do. But they mistake this as a spike, and instead, I think 26 was the spike, and this is the channel. So what comes after the channel? Trading range, rather than this is the spike, and then we're going to get a channel after that. So I hope that made sense. But big bull bar closing near its high, 31. Do you buy above 31? I thought it was okay. I thought it was a big enough bull surprise that you could take the buy. What's the problem, though? We had a pretty tight 5-bar bear micro channel leading up to it. So I'm not sure how much more of a rally we're going to get without at least some sort of attempt at a pullback. But I thought there was a reasonable enough chance that we get a vacuum test of the bar 7 close that it was okay to take the buy above 31 and see what you get. And you can see we got back to the high tick of bar 25. And instead of the bulls buying more and turning this into a vacuum test of somewhere up here, they instead sold out of their longs. And that's what caused 32 to close disappointing for the bulls. An inside bar high 133. Do you buy above 33? You probably can, but you want relatively fast follow through. If you're taking a buy like this, you don't want to see the market go sideways. What you're hoping is that the bulls who keep exiting, who maybe exited up here, are starting to feel trapped out. And you can see what you needed to get was really good follow through on 34, and instead you got a bull bar with a tail on the top. So it was okay enough follow through to still stay long. And I thought if you were long above 33, the inside bar high 1, your premise was still valid, trying to get back to the bar 7 close, which is a magnet above. But your follow through on 34 was not ideal. What you're looking for here is a give up bar. You're looking for a spot where the bears who are shorting say, okay, fine, the bulls win, and then they exit the trade and we get a bounce all the way up to here or even to yesterday's low. And instead what happened is you got an outside bar on 35. The market should not have traded as low as it did, that far below the bar 34 low. It shouldn't have even traded below the bar 34 low if we were going to end up getting the rally up to the 7 close, because you're hoping that you're buying in a spot where it's a higher probability that we're going to race to these magnets. So if it's high probability that we're going to go to these magnets, why are we trading below bars? It doesn't really make sense. It should just rally straight there. And that's why when 35 gets back to the entry price of 34, traders, it is a bull close on 35, but a lot of traders, this trade has not gone the way they wanted it to. So they just, take a point or whatever they end up having, or just break even, and they exit the trade. And that's what causes 36. So, generally any breakout above a wedge is relatively 50-50. And you can see we tried to get the breakout above the wedge on 32. We tried again, 35, and we're trying again for a third time to break out above the wedge on 37. Similarly, it could be consecutive tops. We had the parabolic wedge, and then we possibly have a wedge channel 31, 30, 35, 37. And 37 is a big bar with big risk. So if you're buying above 37, you're buying relatively high in the range, big bar, big risk, and possible consecutive tops. However, it's a big enough bull bar that it's a bull surprise. An outside bar, we're probably getting at least a second leg up, and you're always in long, and it's a bull bar closing on its high. So it's reasonable to buy above 37, but you just have to recognize that there are a lot of problems with that kind of trade. When you get disappointing follow through, a bear doji bar on 38. Buying above 37, you're probably not going to get amazing follow through because you're buying so high with such big risk. So a lot of traders look to buy lower instead. A lot of traders who bought 37 are disappointed in 38 and exit around the close of 37 during 39. Bad low one short for the bears below 38. You could argue it's actually a wedge short, a wedge top of some kind, but I don't think anyone wants to sell the doji bar 38 after the big bull bar 37. 39, initially, you can see some buyers below 38, and then 40 outside up, but 40 triggered the high one above 39, and it's a bear bar on 39, so it's really not all that great to be selling. Probably going to end up going more sideways here. We get a big doji bar on 40, which is disappointing. I think, if you had bought above 37, 38, 39, and 40 is not really the follow through you wanted to see. So it's becoming rather concerning for the bulls, and if we're going to get a rally, it needs to be relatively soon. And you get a big outside up bar on 41. So 40, 41, outside up. probably at least a 60% chance of some sort of follow through. You can see we did get to the 7 close, which was important, but probably going to get at least some sort of continuation on this rally. 42, an inside bar, a high one for the bulls. It's okay to be long, but we're moving up in a channel, not in a spike. So buying above the bull bars isn't necessarily as good as buying the pullbacks. And the upside is probably rather limited. I think yesterday's low is the target. 43, a bear bar. Bulls will exit below 43, which is why a lot of bulls buy the close of 43 and put a stop one tick below. Additionally, where did traders scalp out, right? So what causes 42? Well, the bulls who bought above 37, able to make 5 points, basically towards the high of 43, and that's why they end up exiting and causing that bar. But a lot of traders buy the close of 43, low risk, knowing that they're basically risking, a little over a point, and they're trying to make probably 7 or 8 points. So this doesn't have to work all that often for it to be a profitable trade. An inside bar, 44. Disappointing that there was a tail on top of 44. I thought if it was in its most bullish form, 44 would close on its high and be basically trying to break out right above the 43 high, and we'd probably get a vacuum test of yesterday's low. But instead, big tail on 44, making me question how bullish is this really? I thought we were going to go up here. Follow through for the bulls on 45. Good for the bulls, but a lot of overlap. And you can see traders were losing confidence and they ended up exiting 46 because these are not all that great of bars. And although it's high probability that we're going here, it's not high enough probability to make traders stay in since we have these big tails and traders exit 46. But again, 46 gives traders another chance to buy with low risk. So you can see when we're up here and traders have big risk, maybe good probability, but really big risk, they don't really want to buy. And then when they get small risk on trades like 43 and buying the close of 46 with a stop below, traders are looking to take the trade. So traders are more focused on their risk, it seems, right now. And everyone knows the magnet, this low. Inside bar high 147, but 46 is concerning. It's a pretty strong bar and it shouldn't happen. Again, I think we're trying to get here, but I'm not sure when. An inside bar, 48, good for the bears, okay for the bulls. In II, 47, 48, probably a final flag. Bulls are hoping basically for a vacuum test and a bounce up to here, and then traders exit. 49, a bear bar closing near its low. I think bulls will exit below 49. The double top, a failed breakout above a final flag, but I'm not really all that sure about selling it. If you do, you probably need a wide stop. 50, disappointing follow through, relatively expected from the bears here, and probably sellers not too far above. And you can see we got a failed breakout above the high on 51. 52, a bear bar closing near its low. Good for the bears. My big problem with selling here, I didn't mark most of these sells. I did miss the bear trend, but I thought that we were probably going to close the gap with yesterday's low because this looks like a trading range day to me. It looks like not a bear trend day, right? So if it's any sort of bull trend day, we should close the bear gaps. And if it's any sort of trading range day, we should probably close the bear gaps. So I was struggling a lot with the fact that we had not closed this low yet or gotten to this low yet. And it made me worry that 52 might not be as great of a sell as it seems to be. Disappointing follow through 53. If you do take 52, you have to realize that you're selling against a really strong bull channel, which is relatively okay in trading ranges, but you just have to realize that we're probably going to go more sideways to down rather than straight down. 54, a high one buy for the bulls, but I think it's too late. I think if we were going to get some sort of rally up, we probably already would have gotten it. And then you get an outside down bar on 55. What's interesting about 55, well, a couple things. If it's trading range day, we have this open gap, like I said, 21 and 23, and we might have to close it. And if it's trading range day, we have 51, and now we have an open gap with 55. So that's a set of trapped traders that we now have trapped traders on both sides, right? We have the bears who are trapped all the way down there on 21, 23, and the bulls who are trapped within the context of 51 and 55. And currently, the bears have a bear bar closing near its low 55. So I think it's a credible sell 55, but you're selling against still a pretty tight channel, and it's possible that 52, 53, and then 55, 2 legs down, second leg trap 55. So it might not be as good as you want it to be to sell below 55. But I still thought it was probably reasonable. 56, a bull bar, disappointing. So I think a lot of bears will exit above 56, and instead other traders sold the close of it, and that's why we got 57. If you're selling below 57, you can see the wedge, right? So you can see the wedge 1, 2, 3. So 50, 53, and 55, or sorry, 50, 53, and 56, and 57 closing near its low. So if you're selling the wedge, you're hoping we get a breakout below the wedge, and you want a measured move down to about right here, which is exactly where we went. So the traders, they sold below 57 and they got a quick dip down to the measured move, and then they just scalped out because it's a trading range day, and that's what a lot of traders prefer to do. We did not end up closing the gap with the 21 low and the 23 high on this move down. However, this is clearly trading range price action, so we might have to get back down there. 59, bear bar, but a big tail on the bottom and a big tail on the top, so not really all that ideal to be doing anything. Maybe a sell the close bar looking to close the gap, but I think it's kind of a tough thing to do. Reversal up on 60. I think if you're buying above 60, you're buying too high in this range. You want to be buying reversal up from lower somewhere down here. So some traders, they buy above 60 small, and what do? They put, instead of putting a stop below 60 to exit, they put a limit order to buy more below 60, knowing that 60, although you're buying kind of high, it's a relatively reasonable buy. So they'll take the buy and they'll buy more lower, and when they get filled on their lower buy, they'll look to use any sort of bounce to get out. So that's exactly what happened here. The traders bought above 60, they bought more below 60, and they scalped out. Same thing with 66, right? It wasn't really a great buy above 66, but instead traders bought below 66 and used the rally on 68. I guess here they scalped out at the close. It was disappointing that we kept selling off at the moving average. But anyways, 60, big double bottom with 58. Bulls are hoping it's a big wedge, maybe 53, 50, 56, and then overshoot 58. So reversal up 60. And they're hoping we get back to the 51 low, but the channel down is pretty tight. So I don't want to take the first reversal. I'd rather buy a smaller bar from lower. And you get disappointing follow through 61, which ends up being around the entry price of the traders who took the buy above 60. So a lot of them, instead of scaling in lower, a lot of traders just see 61 and they dump their longs, and that's what causes 62. 62, the bear bar closing near its low. Some bears hoping always in short, we probably are always in short, in bear bar closing near its low. They see a bear channel. But for me, I think that there's too much buying pressure here. The big tails 58, 59, 60. So probably buyers not far below. And it was reasonable to buy below 61, so we should get back to the 61 low. Disappointing follow through 63, and then outside up 64. So you can see we touched the 60. No one wants to sell below 63. Bad follow through. So some traders buy below 63 and they scalp out at the 61 low. 65, it's potentially a double top for the bears, 63, 65, or micro double top 64, 65, but obviously a bull bar, so no one wants to take that. And you can see traders instead bought, but then 66 closing near its high. But do you want to buy above 66? Probably not. It's probably better to buy below 66, the same way it's better to buy below 60. And you can see on 67, the rally up to the 60 high, traders ended up exiting, and that's what causes the big outside down bar 68. 67. Am I selling below 67? I probably wouldn't. We are always in short, but we might have to get back to the 66 close. We do have failures at the moving average, so 61, 67. We do keep failing at the moving average, which is really important for the bears. 68, you can see we got a rally back to the 66 close and then sold off. 69, I thought 69 was actually a pretty credible buy. I'll check Al's chart tomorrow, but I didn't really have a problem with 69. Thought it was a possible wedge, 1, 2, 3. First off, you could have a 3 push pullback, 60, 61, 63, 65, 66, and a failed breakout below. And if it's a trading range day, you're buying a small bar. It's towards the bottom of this trading range, granted not the whole thing, but you're buying a smaller bar, and you might be looking to get a bounce back to the open of the day. Doesn't mean we're going to go straight there, but I thought it was credible to take the buy above 69, looking for a bounce maybe to the open of the day. Thing was, you probably have to have a stop and measure move down because it's a smaller bar. So the one way to look at it was, I thought 3 push pullback, and we should get 2 legs sideways to up, failed breakout below the wedge, or just a different way to look at the wedge, 60, 64, 69. Either way, I thought 2 legs sideways to up. I was pretty, we got 70. I thought 70 was disappointing that it closed on its low, but it was unlikely to get follow through. And instead, we get a huge bear bar closing near its low, 71. 71 was a climactic bar and probably should not have happened. So I thought, obviously you have bulls that got trapped. 72, a bull bar closing near its high, but the buy was probably the close of 71, betting against a big follow through bar, and they used 72 to probably just scalp out of their longs. Traders, they see big bear trap, right? So you see the bear channel down, an attempt to break out below the bear channel, and a bear trap 72. Traders buy above 72. I probably wouldn't. It's a really big bar and big risk. I'd rather see what 73 looks like. We probably should get back to the 72 high, though. I was kind of surprised that we sold all the way off and never got back to that high. I would imagine that tomorrow, if we get back to the 72 high, it'll be resistance. 73, you can see we tried to test to the 71 close, and bulls were hoping bears were going to exit. Again, I think a lot of the reason we got the breakout down like this was because we never closed this gap, which I thought was really important. 74, follow through for the bears. Consecutive bear bars closing somewhat near their lows. Sell the close, but I thought big problem with how big and strong 72 was. It's probably a trading range day still. 75, follow through, and then a very climactic bar on 76, and more of a buy the close bar than a sell the close bar. And you get a big reversal up 77, and then we go sideways for the rest of the day, never getting back to here. For stop orders, I thought 8 was good. I thought 13 was reasonable. Probably 18 was reasonable. Probably 19 was reasonable too. But you are selling relatively low, so you might have to sit through a pullback. Strong buy above 20, but a lot of traders will scalp out in here after they see the wedge. I would not sell these. You can probably buy 31 or 33. I thought 37 was okay, but big bar, big risk, relatively high in what's probably a trading range. So a bit difficult. But magnets above, so we're probably going at least a little bit higher. 42 is probably okay, but difficult. You don't really want to buy that high. I did not sell 52. I thought, I guess you can. It's a bear surprise bar. It's stronger than it should be. And we do end up trapping traders, so 55, probably okay. I thought 69 was fine, and I probably wouldn't sell 70 because, I guess it's a reversal down from the moving average, always in short bear channel. Bear bar closing near its low, so it's probably okay to sell 70, but I was just, I was more in trading range mode. A lot of times when you have the final 30, 40 minutes of the day, final hour and a half, maybe actually of the day, you have like one trade that you want to take, one specific setup in mind. And ever since bar 60, I was thinking we might get some sort of attempt at a reversal up, but I wanted to buy, I saw this, I thought I wanted to buy a smaller bar from lower. I thought 69 was pretty credible for that. So maybe I'm wrong, but I thought that was okay. On the daily chart, a good bear bar closing near its low. So good for the bears. But again, I don't think this is a major reversal. I think this is probably going to be a minor reversal. It's possible. So if you think about it, traders know that we're probably going to close these gaps here, and here. So it's possible that we just get a vacuum test down to here. So you have to be aware of a big bear trend day tomorrow. But I don't really think it's all that likely. I think more likely the traders who are selling here are going to end up with something disappointing, and we're going to continue sideways. But it's definitely possible tomorrow that we get a vacuum test, just basically right down to the high of May 3rd, because traders know we're probably going to get there anyways. So I thought that was interesting. Additionally, if you look at the monthly chart, bears are trying to put as big of a tail as they possibly can on this monthly chart bar. So the bulls who bought up here are probably disappointed in this, and they might be using this rally to get out. So I thought the midpoint of the week was the midpoint of the month was pretty out of reach. Tomorrow's the last trading day of the month. And it's going to have to go, 50-ish points to get to the midpoint of the month. So I would be aware of around the 5,200 price point tomorrow, and we'll see what happens. The weekly chart. So tomorrow is the last day of the week and the month. So you have to be aware of a big move, which is, relatively common when you're in the last day of the week and the month. But again, I think any reversal down is probably going to be minor. This just looks like a trading range for me to me. All right, that's today.